Welcome to the next lesson. Today we are going through understanding cost of capital. Now, when you talk about cost of capital, we'll do the introduction, we'll look at the components, and then finally we do the preparation or computation of cost of capital. Introduction. What is cost of capital? Capital being the backbone of every business, hence require a thorough decision on its allocation. The rate of return in the fund is required to make from capital budgeting of a project like construction project, building project, etc. Determine the best source of capital the firm gets when it makes capital budgeting decision. So when you talk about cost of capital, this is the best decision the company or an organization is making on the basis of how they will get the source of capital. Components. There are three components. One, the return at zero risk level. Expected rate of return when a project involves has no financial or business risk. Two, business risk premium determined by capital budgeting decision for investment proposal. That means when the business risk is involved, the higher the rate of capital or cost of capital. Then financial risk premium relate to the pattern of capital structure of the firm. That means the composition of capital from equity, share preference, debtors, debentures, etc. Now, the formula for the three components is K equals to RO plus B plus F, whereby K is the cost of capital, RO return at zero risk level, B is business risk premium, and F is financial risk premium. Now, computation. How do you compute cost of capital? Computation of cost of capital involves the following: specific cost and composite cost. Specific cost. Now, in specific cost, the cost which is associated with the particular source of capital. So we are dealing with each and every source of capital. They include the following: one, cost of debts. How do you get the cost of debts? You say KD equals to I divided by P, or I divided by NP, whereby KD stands for cost of debt capital, I stands for interest, NP stands for net proceed. Net proceed means if there is premium, if there is discount, if there is expenses incurred in the acquisition of particular source of capital. Now, cost of capital after tax equals to cost of capital before tax times 1 minus tax. Gives us the cost of capital after tax. Cost of preference share capital. This is number 2, specific cost of capital. How do you get that? The return raised from preference share capital, there are two ways. One, through irredeemable. In the redeemable, the formula is KP equals to DP divided by NP, whereby KB, cost of preference share capital, DP, dividend per share, NBP, net proceed. Redeemable. Redeemable means shares which can be renewed after the expiry period. The formula is KP equals to C plus in bracket D minus NP divided by N divided by D plus NP in bracket divided by 2. C is annual dividend, D is dividend per share. That is the composition. Now we come to the cost of equity capital. Minimum rate of return a firm must get on what they have invested. So the minimum rate you get after investing in equity capital dividend preference, dividend price method. That's number one method. In this method, the formula is KE equals to D divided by NP, whereby KE is cost of capital, D expected dividend per share, NP net proceed per share, dividend price plus growth. That's number two method. Under this method, we consider the growth of shares, KE equals to D divided by NP plus G. Earning price per method. That's under equity, KE equals to earning per share divided by NP. Cost of retained earnings. This is number three method of declaring cost of equity capital. Under this method, the portion of the profit retained by the company for future development, which we have KR equals to KE in bracket 1 minus T in bracket 1 minus B, whereby, so let me take you back, whereby T is tax, P is actually progress cost, composite cost of capital. Under this method, the combined cost of different sources of capital taken together, we do the weighted average cost of all the specific costs of capital. How do you do that? Steps. Number one, compute the cost of each cost of capital. Number two, assigning weight to each specific cost. Number three, multiplying the cost of each source by the appropriate weight. Number three, finding the sum of the product. Formula. The table of computing the source of capital. That's the table whereby we have source A, amount B, weight C, cost D, weight cost is C times D. Point of correction, it's supposed to be D. So these are the source of capital, equity, preference, debentures, and retained earnings. So you need to get this. At later stage, we'll see how to do the calculation. Now the problem. We have a problem. This is the problem. Best Limited had the following capital structure as at 31st March 2011. Ordinary share capital, 200 shares, which is 4 million. 10% preference capital, which is 1 million. 14% debenture capital, which is 3 million. Additional information, we have the market price of each ordinary share was $20. The company paid dividend of $2 for each share on ordinary shares. Annual growth rate of dividend is 7%. Then corporate tax is 30%. You're required to compute the weighted cost average of capital. Now, this is how you do it. Specific cost of capital. Now, from the question, what you realize is that already we have been given specific cost of capital. For equity, is not there. So it's now upon us to do the calculation. So from the question, the cost of capital for equity is KE equals to D divided by NP plus G. So 2 divided by 20 times 100 plus the growth 7%, which is giving us 10 plus 7, which is giving us 17%. So the cost of capital for equity capital is 17%. Now for debts, which is debentures. Remember, debentures we have been given 14%, but it is before tax. So we need to get after tax. So getting after tax, we say KD after tax equals to KD in bracket before tax times in bracket 1 minus T close the bracket. So this is the value. So 14 times 0.6. When you add that, when you multiply, you get 8.4%. So the rest have their values. So we go back to the table. Now this is the table which will help us in computing the composite cost of capital. Now we have source, ordinary shares, 12% preference shares, 14% debentures, and retained earnings, we don't have it. So from the question, we have 4 million amount, 1 million, 3 million. Now what you do, how do you get the weighted cost apportionment? You say 4 million divided by total 8 million gives you 0.5. 1 million divided by 8 million gives you 0.125. 3 million divided by 8 million gives you 0.375. Cost of capital, specific capital. For ordinary shares, when we did the calculation, we got it is 0.175%. Now, for preference shares, it's 12%, so we are writing 0.12. For debentures, it is 0.084, the one we have done the calculation. Now, weighted cost will be the product of the weight and cost. So 0.5 times 1, 0.17 gives you 0.85. 0.125 times 0.12 gives you 0.015. 0.37 times 0.084 gives you 0.315. Now you find the total, find the sum of the product. Now the sum of the product will be 0.085 plus 0.015 plus 0.0315 gives you 0.1315. Now this gives us what we call the final solution will be 0.015 times 100, which is 13.5. Now this is the cost of capital when you use weighted average method. Thank you so much. See you then.